And so let me welcome and invite on the stage Mr. Rob Cox, Global Editor of Reuters BreakingViews. So please jump on the stage. Well, thanks again for coming. Enjoy the discussion, and over to you, Rob. Thank you.
Thank you very much. Grazie, Luigi. Can you hear me? Is the mic working? Good. Grazie di essere venuti. Parliamo in inglese, okay. Thank you all so much for coming. This is the 8th of this particular series of predictions. We've been in New York, London, Toronto, Mumbai, Paris, Davos, Switzerland, Hong Kong, and we've saved the best for last, which is Milan. This is our favorite place in many respects, certainly one of my favorite places. And we have a really special evening. What we're going to do is I'm going to talk to Alessandro Perazzelli for about 10-15 minutes. Then we're going to bring on the rest of the panel. Lisa, who is our Milan columnist, is going to have a robust discussion about rebuilding Italy, rebuilding Europe, and banking union, all those other exciting things that you all have come to hear about. Before that, I want to do a quick bit of housekeeping, because you are all going to be asked to help us out tonight. This is going to be a bit of an interactive evening. First, note the safety. If you see if we have a fire, please don't panic. Find the nearest exit. Here's how you can log on if you're having a problem, so that you can then tweet using the hashtag BVPredicts at BreakingViews. We hope you do that. And then the other thing I want you to do is actually, I'm going to ask you a couple of questions. So, first of all, if you go to this little thing on your phone, and by the way, this is about the only time that I'm ever going to ask people to take out their phones while we're having a panel discussion. I know you're not shy in Italy about using your phones, so particularly tonight, be robust with your use of the phone. If you go onto Slido, you'll see that we're going to ask you some questions. Some polling questions. We'd like you to give your views. And you can also ask questions of our panel using this app. We're going to do that rather than run around with microphones, because that will just waste everybody's time. So let me start with the first poll question. This is so that we can see that it works. Matt, why don't you give us the first polling question, and we can ask folks in the audience to get their phones out. And do we have that question? Well, we will. We definitely will have that question. Is it maybe on the app? Is that why we're not seeing it up there? Is that the... Let's go to Slido. If we don't have it, I'm going to just move on. Do you see it on the app? You see it there, okay. So I guess we don't have it up on the thing, but I'm gonna ask you guys. All right, Davide, thank you. Okay, this is just to get started and warmed up. Who will win the U.S. presidential election? So if you go to the app, you'll see you have a choice of Elizabeth Warren, Mike Bloomberg, Donald Trump, who's the president of the United States right now, Joe Biden, who was the vice president, and Bernie Sanders. So please go in there and vote. We'll somehow get you the results. Do we have those? Do you see them? Okay. Okay, good. People are entering them. Wow. Donald Trump seems to be gaining the lead. I'll give you 5 more seconds. Donald Trump still ahead. Okay, well, Mike Bloomberg, he's putting in a pretty good effort there. We're about 57% of you think Donald Trump. It's actually not that bad. We've had higher in some of these other. I'll give you, when we ask this question, we've asked this question everywhere, the same question, except New York. In New York, where we asked people, if the election were held today, who would you vote for? We got quite a different answer. I think Donald Trump came in with 26%. In New York, yeah, because I didn't want to ask you all, some of you can vote in the United States election, but it wouldn't be fair to ask you that. Okay, so that's Donald Trump. The next question, which leads into our next topic, can you give me that one again? Okay, if you look at the next question, which economy will deliver the biggest upside surprise in 2020? You have a choice of India, Great Britain, Italy, the United States, or China? So there's often a little bit of a home market bias on this thing, I've noticed. But everybody seems, no, but India seems to win everywhere. And India has won here. I'm afraid Italy is just a little bit ahead of China. Oh, we got it? Okay, bravo. Okay, there you go. Well, if you'll see in the book, just incidentally, that you've all got the predictions book, we have a piece that says that look for an economic surprise from Prime Minister Narendra Modi of India. And when he surprises people, it can be quite a surprise, so be wary. Okay, good. On that note, this is a great opportunity to bring Alessandra Perazzelli, Deputy Governor of the Bank of Italy, up. Well, I know you will talk about consolidation in the next part of the panel, but two quick questions. One, so sustainability. The Bank of Italy is part of this network for the greening of the financial system. There's something like 50 central banks, even more other observers, notably not the Federal Reserve. But what are you looking? Yeah, I mean, how are you looking at climate change from the sort of regulatory perspective? Do you see it? Is there a role that regulators play, or want banks to play, or is it sort of defensive in the sense that we see this as potentially a problem for financial stability down the road? I mean, what are you learning from this network?
I think it's both. I think that what we do is we're part of this network, and we're working with the European Commission on their paper, and we're working at different levels in the G20. And we do offer technical advice on all of these issues. There is a whole overall understanding of how to address brown assets and green assets, and that is how that's going to be part of the book of banks. So that is, let's say, more like of a, I don't want to call it an intellectual exercise, but it's definitely something that we participate to, being aware that we're not going to be the main owner of any policy on a number of issues. However, I think that the ability to understand these risks is fundamental also in order to provide a framework for stability at financial level, and that is where we want to be more and more involved. We are right now within the Bank of Italy moving towards creation of different departments. So we're in a very creative mode right now, and so we're going to be tackling fintech and tackling green economy, and also tackling everything which is more related to financial education and issues that concern consumers.
So you're going to have a special department that
We're going to have some special,
sustainability
on all of these, with a different level of sort of creating mainstream structures that can address these issues in a more less siloed approach.
Right.
And these are very important because we do understand that we also have an issue of pushing banks in order to understand what we're facing right now in all this different kind of innovation.
Great. Well, the last question is about gender diversity. So
right.
you were put on the governing board last year.
Yeah.
There are not a lot of senior Italian women in finance, much less. I think you're the first Italian woman on the SSM board, supervisory board.
Yeah.
What is your, how is Italy going to address this? How would you suggest Italy just address this gender gap? I mean, finance, of course, is a bit of a dude business everywhere, of course. But I mean, it is particularly so here, and also in other high levels of Italian leadership. I mean, how are you helping to break that glass ceiling?
Well, first of all, I think the gentlemen here, they should be more proactive and promote women in your organization.
Your fault, yeah.
You guys, you all. So I think that first of all, I think that coming to terms with diversity and coming to terms with having women on an equal footage into organization is still an issue for the Italian culture. In terms of what's happening in the Bank of Italy, we do have a governor which is extremely careful about this. So we are right now kind of trying to really groom a number of economists, ladies who are at mid-level right now, and pushing them forward. I'm definitely doing that. I have a bit of a history, I have to say, Rob, about these things, pushing women up. So I think it's really an issue of culture. I think it's one of the issues that is concerning about our country because it got linked together with excessive bureaucracy, to age issue, women issues, bureaucracy, lack of dynamism. It's all bundled together, and I think it's something that needs to be looked at in terms of like how to promote more innovation and a more dynamic ecosystem in order to make business and to go ahead. There are a number of things that can be done. I'm not going to repeat them, but most of them are really, the gentlemen here who have the power to promote people just to do that.
All right, guys, you heard it.
You heard me.
So, Alessandra, thank you very much. I'm going to let the other panelists come up. You've got assigned seats. Give Alessandra, let's do one poll. So in the meantime, as people are getting up, take out your phones again. Let's do another poll. Are you guys, go on up, you're good, and I'll sit here, but maybe let's just get one last poll. Should we try to do that? While everybody's getting their mics set. Okay. Where will we see significant regulatory changes in the coming year? Will it be in the issue of banking union, which these guys are going to talk about? Reform of the Stability and Growth Pact. ESG regulation. E is the environment, S is social, G is governance. The E will be anti-money laundering rules, or E will be inconclusive as usual.
We're having a mic problem here.
You have a mic problem?
Yeah, Alberto does, a technical problem.
Here, I can play technician.
Fatto?
Okay. All right, thank you. Take it away, Lisa.
Okay, thank you very much, Rob. Thank you, Alessandra, for the initial insightful thoughts on the health of the Italian banking system, a little bit on regulation, and some of the issues we want to sort of go deeper into this panel. Before we start our conversation, however, I just want to remind you that you're able basically to ask questions to the panel if you go to slido.com, so this app that we're using, and if you type your questions there, we may select your questions later in the discussion. We'll be able to sort of see those. So please, if you want to sort of interact with the panelists, make sure you ask the questions through Slido. So very briefly, we are lucky to have, of course, apart from Alessandra, we have a number of market practitioners, 2 bank CEOs, 2 leading investors, and we want to basically get a little bit deeper on the health of the Italian banking sector in this second part of the discussion. So, as we've heard, from a balance sheet perspective, we can probably say that European banks are healthier. Just yesterday, Andrea Ria presented the annual ECB review of European banks, and capital ratios have been going up. You mentioned, Alessandro, that the NPL ratios have gone down. In the case of Italy, it's interesting to note that the average capital ratio is now at 10.6%, let's say on average for the system, which is twice as much where it stood in 2007, so before the financial crisis, while the level of NPLs is half, as you said, the level it was in 2015 when we had the peak of the bad credit crisis. However, there is a problem. So banks are not very profitable. They're not very profitable in Europe. They're not very profitable in Italy. There are very few banks in Europe that meet their cost of capital. I think, Alberto, maybe your bank just about manages that, but they're not many. And there's a number of facts. Low interest rates, upcoming regulation. So since we have discussed just regulation, we just asked these questions to the audience, maybe I want to start from that. I would like to understand from the bank CEOs for a start, how big a threat is the potential upcoming regulation. Maybe I'll start with you, Giuseppe, if you agree.
Why not?
Just, from the other side of the panel, how can banks cope with increased demands, which are still being placed on them, and be profitable? I think this is, in a way, the question that we all like to answer. So if you can help us with that.
I wouldn't put directly in correlation the regulation with the profitability, but for sure we were pushed during the last 3-4 years, during the first year of the SSM, to really be concentrated on two issues, the risking and capital accretion. So of course maybe the consequence of this act were to increase capital, so to be in a ROE environment which was not satisfactory, because if you double your capital, you cannot double immediately your profitability, and at the same time to make a lot of sacrifice in terms of NPL reduction, which means a lot of money to be put aside in order to pay the difference between the book price and the price bought by the investor. So I think this was the main issue, frankly speaking. Then the interest rate are doing the difference, because for us one of the two mainstream of profitability, commission and interest, basically one of these is down almost completely. On the deposit side we are losing money, on the loans we are of course in a very, very low rates environment. So this is a problem, we have to face it in some way, and this is a problem especially in Italy, where we have too many banks. So for sure, this doesn't help.
What is the solution? I mean, you just mentioned
I already did something.
He raised the ball.
Yeah, you raised. So maybe Alberto, I mean, I see that you maybe want to sort of, I mean, by the way, you're all free to sort of jump in. You don't need to sort of necessarily wait for me to ask
I
questions.
fully share what Giuseppe was saying, and since regulation has been quite heavy, but now we are having a good visibility in the next few years about what is going to happen. So you have Basel IV impact that is now more comprehensible. You have TRIM effect that is more comprehensible. Which is less comprehensible and to me a bit underestimated by the market is all what is relates to new credit provisioning and impairment. So calendar provisioning, IFRS 9, new definition of default are going to impact further, I think, the profitability of banks, in particularly those banks that, as Giuseppe was saying, are still halfway in their balance sheet cleanup, because it's true that in Italy we have done the most in terms of progress in cleaning up the balance sheet of banks, but if you take the mean of I would say tier 2, and this is not by chance that I'm meaning tier 2, because I do expect consolidation in Europe in tier 2 rather than tier 1. If you take into consideration the average NPE ratio of tier 2 is still 9.9. So 9.9, of course, included Montepaschi, that of course is helping the mean, but 9.9 is still far from 5, that is the target of SSM, and is still a bit far from the average in Europe, that is 3. So adding on what Giuseppe said, so low visibility, in particular in tier 2 banks, of a revenue increase, because you have pressure on NII that is related to low interest rates, but also the risking, because the more you sell credit, even if they are NP, the more you lose NII.
Yes.
Then you have a good stream this year, maybe lasting for the whole year, of fees, but the proportion of NII as opposed to fee is such an Italian bank's balance sheet that you need to work a lot on fees just to recoup only the NII gap. And the quality of fee are not always the same, because we all know that 2019 was featured by a lot of upfront. Upfront fees are important, are still the name of the game in the beginning of this year, but qualitative-wise are not of the greatest standard, no? And their sustainability may be challenged. So basically, revenue under pressure, cost flat at best, because you have wage inflation plus basically all digitalization. Cost of risk that is estimated to stay flat or even going slightly down. But here again, I'm not so sure that the calendar provisioning, when it starts to hit, will make a rebound, create a rebound in cost of risk. This is leading to the fact that 2020-21 average ROTE, return on tangible, of Tier 2 is going to be in the region between 5 and 6. So this is going to the second point that also Andrea Enria was evocating in his latest, or in one of his interviews, is that consolidation is a way to recover profitability. And this is going, according to my sense, to be more on the agenda of CEOs this year because of, as I said, ROTE, half of cost of equity. I would say the fact that they could participate better today because they have de-risk. So SSM, but I'm asking my friend Perazzelli, will be less, I would say, against merger if the two participating banks are cleaned up and in better shape. And I say also in Italy, we still have this kind of stability at political level is important because you know which is the incidence of govies and govie spread on capital. So the more we have a spread in the region of under 30 and 140, the easier it is to engage into M&A talks. So I think that Tier 2 in Italy, Tier 2 also in Spain, and also in theory, but not in practice, in Germany, should be a bit the activity that we shall see in the coming months.
Okay, just following up on a couple of points you made. I mean, Alessandra, if I can bring you into discussion again, because Alberto mentioned you, what exactly is the position of the regulator? Because when I speak to a lot of players in the market, they say, well, consolidation hasn't happened because the ECB is going to ask us to raise capital, so much, and this is just impossible, and the bar is too high, and this apparently has been a deterrent. I mean, is there maybe a different approach or a slight change of view from the regulator, given that this consolidation, which could be beneficial, is not happening?
Yeah, I mean, I think both at SSM at our level, we see consolidation as a to-do, is on that to-do list for this year, for definitely. We are bringing within the SSM a concern about capital requirements. We're working on that right now. And we also want to see de-risking, which does not cover NPL, but want to go into level 2 and level 3 market risks. And so we want to see a number of highly opaque instruments that do not have a secondary market. We want also to have a cleanup that doesn't only concern our system as the Italian system, but do concern other systems. We have now started a process of bringing on board also other NCA on these specific issues. It is a long-term work and not something that is going to happen overnight, but we do think that with this chair there is a lot more room for a strategic approach that is going to help consolidation both at cross-border level and for what it reserves, to our country, to our industry.
Okay, so let me maybe bring in the investor perspective, to the debate. So if I look at the valuations of the banks at the moment, European banks, Italian banks, they're trading half their book value, more or less. So is this, I'm asking this to Davide, is this potentially an opportunity if, in the context of what we heard, maybe, a move towards consolidation, maybe, or is it kind of too risky because of the ultra-low interest rate environment and some other regulatory questions maybe? How do you see, how appealing is the banking sector, European and Italian, to you?
So I would say that from a global perspective, first of all, Europe, as it's a lower growth area and it's the only one with negative interest rates, that's not the place where, unless you're a very good banker, you're not going to make money, simply because it's cloudy. Yeah. So here, to make money, you need to be good. Just to be basic, if you take the current return on equity in the US, you take the current return on equity in Europe, if you adjust for the difference in short-term rates, you're explaining more than 70% of a gap in profitability. That's just basic math. So when I started analyzing banks, interest rates were 6%. Yeah. Banks basically transfer spread, so they borrow from the central bank, they pass money away, but that nominal serves to cover their cost, because the cost base of Giuseppe and Alberto are nominal, they're not real. They can't go to their employee and say, hey, we're going to pay you less, yeah, or the cost base. The second issue, I think, is then Europe as a whole, it's underrepresented in global portfolio. So recently I was presenting at a wealth management event for Morgan Stanley in Hong Kong, and the allocation to Europe for the two largest wealth managers in the world, Bank of America and Morgan Stanley, 5 trillion savings, it's tiny, all-time low. Why? They're bearish on the euro. 2, they hear Donald Trump that wants to put tariffs, so you stay away. And 3rd, in Europe, we're not great in self-help either. Means lots of talks, lots of debates, very few action. Having said so if today I stand by, I look at European banking sector, take today's Santander results. Take Santander because it's the largest bank in the Eurozone. So it's the largest bank in the Eurozone, generates 30 basis points of capital per quarter, so about 1.2%, has already factored in all the bad news of any regulatory changes, trim, not trim, for the next 3 years. So basically, all the bad news for the next 3 years brought forward. Has a current return on equity of 8 to 9% and a 6% dividend yield. It's a company that never lost money in 175 years too. Now, as I love to look at history, if you take the S&P 500 or 505, there's only 3 companies that existed before the 1900s. So let's say Santander has been here for 2 centuries, never lost money in any given year, sprinting an 8% return on equity, gives you 6% dividend yield, and all in all, meets its cost of equity, and it trades a discount to book. So for me, it's a fantastic investment opportunity. I say that and own it. Then the high discount price to book, in some cases, and particularly in Italy and others, were led to the fact that people believed the book wasn't real. Yeah? And we had some issues where the book were faked.
Well, even recently, right?
Sorry. We had it first, the highest fake books were in the Popolari banks. And for a simple reason, we always said corporate governance was a joke. 2, the regulator had the hands tied, particularly in Italy, till when the SSM got real power. So they could only moral suasion. But moral suasion, it's you arrive at the end, it's too late. Basically, that's what happened. We've always said it. We've been ultra vocal, even too much. Yeah, I've written letters left and right, and I think finally this is clear to everyone. It was very clear in Spain. It got clear in Italy too. But if you exclude that sector, the remaining sector has been dealing. And I think, for example, in the case of Italy now it's clear. But yes, the stock of NPL remains high, but the collateral value on the other side is high too. So we, 5 years ago, became one of the largest investors in NPL in Italy. We have 20% market share in the secured market. With Giuseppe, he basically took us to one of the most competitive auctions ever. Well done, Giuseppe. We're earning our return, but I can tell you it's a fair return, not dissimilar from the one he's making on his core business. And I think the beauty is the regulator, the banks got in serious, and within 3-4 years, you had a massive reduction. So I think it's positive. All in all, though, the key issue is with digitalization, if you think about it, money is made 100 of the wealth in the world, less than 3 is actually printed in bills. The rest is already digital. So digitalization has a huge impact. And if you take the footprint of how many people need to go in a physical branch today, taking California or, let's say, Stockholm as an example, today in Europe, unfortunately, we probably have 40% too many employees in the banking sector.
Yeah.
This has happened to newspaper. Digitalization disrupting any business is disrupting banking too. Because banking has been run as an utility so far, it's now having to face this issue. The only way to solve it is less bank. Now, take the most profitable banking system in the world. Canada, Australia, UK, US. What do they have in common? 4 banks, 80% market share. Okay? So if you think about Europe, US, the top 5 banks had less than 15% market share of profits pre-crisis. Today, they're at 60. So the issue, I think, here at European level, someone has to, get real and if the fact that we love small is beautiful, each country it's their own country, we're going to end up having today, think about it, 140 regulated banks by the SSM. In the US, there are only 20. Then how can we compete as Europe when JP Morgan alone has a bigger market cap than the #1 bank in every European zone? Because then if tomorrow I'm a large European corporate and I want to issue a bond or I want to do a transaction, I have only one number to call. I better have a JP Morgan phone number. So then the issue is, if you want to give the Americans the data, the largest asset manager, the largest bank, fair enough. I mean, just hand them the economy and hopefully then they run it. Because here you're not going to have much independence. And so I think the Commission will have to have this very clear, because so far the logic has been, if it's great for consumer, it's great for us. Well, it ain't clear. You know, we had the best telecom industry, they destroyed it, because they said in each country 4 players, 27 countries, 110 players. If you keep on thinking that, you know, you need to look at the consumer because it gives you the votes and basically you are a populistic in nature, yeah? Then what's happening? You destroy your own economy, and then you basically are where we are.
I mean, you mentioned the Commission.
Can I add a completely different perspective and a piece of good news? Because we know that the banking system is very challenged. By the way, I'm not a super expert in the banking system. I do represent a large global asset manager. We know that the negative of low interest rates causing a number of problems to the core business model of the banks. But, there is a but. Low interest rates can also create some tailwinds for the banking sector in Italy. Look into another part of their business because they can be used as an incentive to push customers to move the huge amount of money. Don't remember the huge amount of money is currently sitting in cash accounts and deposits.
1 trillion.
Yeah, Larry Fink, that's by the way, very true for Italy. Larry Fink, during an interview recently, made a very interesting comment. One of the challenges in Europe is that, and that's again very true for Italians, people sleep with their money rather than putting their money at work, which is very true. And now, by the way, what I'm saying is based also on a number of interactions with a number of banks. The low interest rate environment is providing this incentive to help people to understand, and when I say people, I mean the actual customer, that it is in their own interest to put their money at work. And at the end of the day, it is a win-win-win setup because it is a win for the customer. In the long term, you can achieve better result and better return and achieve your financial goals. It is a win for the bank because banks can run a very profitable business if they do that rightly. And by the way, there is evidence that banks with strong wealth management units, honestly, in terms of financial performance, you know, are probably suffering some of the things we're discussing a little bit less. Third is better for the economy, clearly, because actually rather than having money sitting old and that being used is a different way to use it.
I mean, this is all very, sorry, I know you want to, I just want to make a remark. I mean, you're absolutely right on that. I mean, unfortunately, what we see in Italy at the moment, it seems that there is a bit of a dichotomy, and some banks are able to offer products, let's say, because I mean, to convince people to use their cash, I mean, you have to maybe offer them an investment proposition, and some other banks maybe are a little bit behind in terms of, you know, I mean, I'm being a little bit provocative here, but Alessandra, what do you mean? I know that the Bank of Italy is also, you know, concerned about this amount of cash.
On this specific one, I mean, the country is pretty much divided in areas where the approach to banking is extremely different, and also the ability of banks to renew themselves and embrace innovation, invest in innovation, put money and put, you know, competence, getting new skills in. It's very diverse. So this is one issue where I think the country is more sort of like weak compared to competition from other European countries and extra-European countries. So this is one issue. The other issue I wanted to mention is demography. Because what we see today, you know, the ability of people to work with you know, technology is not comparable to what we're going to see in 10 years. You know, where our kids, you know, they're all about 20 years old. I mean, you know, I often think that my kids will probably, when they want to buy a house, they're going to ask their phone. You know, they're not going to go into a bank and get a loan. I mean, these issues are issues that we need to tackle as a system, as a European system, as an Italian system, very, very quickly. So I think that there are new rules that have to be put in place that do concern capital requirements, particularly when you have a merger thing. But there are also new rules that have to be put in that concern state aid, because there is a lower level of profitability. You know, I've seen it, my sort of like christening has been with Banca Popolare di Bari, and I've seen it all, and I really believe we have to look at these issues of state aid. And then the other thing that we definitely need to look at is the ability of banks to open up to new services and competition, what kind of competition they're going to face, their ability to invest, and what it means also from a fiscal point of view, invest in fintech, in getting in new competence and new technology. These for me are the going forward issues. I am a little concerned about the ability also of the European authorities to embrace change and to move forward. There's a big issue about moving out of the comfort zone. Mm-hmm. And this is very true, I think, in Europe.
Yes, David.
As I think, for institutional reason, here people represent institution, here is a small institution, so I'll speak bluntly. I actually think in Europe, the bureaucrats that are in Europe are destroying what we have. And let me give you just two examples. So look at banking. So the European had this great idea to introduce PSD2. Basically what it means that today, if I have a bank account with Giuseppe or with Alberto, and I'm Facebook, Google, or Amazon, as a consumer, if I have a bank account with them, I can take all my data and give them to anyone. Something goes wrong, for free. Something goes wrong, they're liable. If there is a hacker, they're liable. Guess what? Also as a UK citizen, Facebook, Google, Amazon in UK pay no taxes. And the
not
poor,
just there,
sorry,
not just there.
Anywhere. And the poor Barclays, Lloyds, those bad guys of HSBC, they pay 40% of a corporation in the UK. So my military, my police, my hospital were actually paid by the bankers. But the good tech guys can take all the data, make all the profits. Now they're not banking regulated. And guess what? They can take our industry. And our smart Brussels bureaucrats, they said that was a good idea. Now, the second issue, which I think is even more tragic in my view, is how savings are managed. So take 100 jobs in Europe. How many jobs in Europe are in ex-public sector? So take the public sector, the private sector. How many jobs are in companies which are listed on the stock exchange? Tell you a number, it's 10. How many jobs are in medium-sized company? 20 to 30. How many are in small company? 70. In Italy, it's actually 75. Now, how many of you, so I take, for example, the case, this is I think, the craziness behind Solvency II, it's another European bureaucrat, who came up with the idea that, and take here, I have the data, take, for example, the largest investor in this country, Intesa, through its life insurance company. If you are an Intesa investor, customer, how much of your savings can be invested, legally, I'm saying, into companies which are not listed? Pretty much zero. It's only 75% of the jobs in the country. So you tell me how you're going to grow your economy when we, with our own savings, cannot invest in 75% of the job sector. Now, why? This is because, not BlackRock, let's say the Anglo-Saxon institution, so American plus UK, had this brilliant idea to go to the Brussels bureaucrats and telling them, liquid is good. So what is liquid in the world? Well, US, Germany, a bit of UK, Japan, and that's it. We Italians were happy because we had the first public debt in the world, so we said, well, we're liquid too. Okay, but unfortunately on that side, not on the other side. And then what happened? We are completely bank dependent. Well, it's very simple. If with our own savings we can't invest it. And when you try to engage with the Brussels bureaucrats, because they have no accountability really. They can't be fired. No one in the Commission can be fired. You can't lose your job in the Commission. Yeah? There are 22,000 people, they can't lose their jobs. So what happens? It becomes a self-reference conversation. And this is why I think in reality, in particularly I think in Italy, which is one of the top exporters in the world, some of the best companies, people need to stand up and fight. And there is self-help. So I think, for example, Bank of Italy taking his vest is trying to change the rules and bending, but for the great good of the country. Because I don't think it's fair for Italian savers to take their cash, invest in Google and in Facebook, they pay zero taxes, then they destroy our economy, then they take our own companies, and everybody keeps on clapping. I'm not happy about it, and so I fight it and I say it.
So it is, I can take your role and ask a question to that.
Yes.
Because don't you think that things are evolving in that space? I completely agree with you, but there are changes. It is very early stage, but all the focus that we see now in the markets, on the private markets, where, and actually also in that we can say regulators have done something good, because we have some frameworks, European frameworks, namely the LTIF, which is taking a lot of, creating a lot of good noise lately, which is a way for the final investors to invest directly into the real economy. So I agree with you, this is where we are, but maybe the world is evolving more in the direction you say.
I think my view is because we're now at a farce level, yeah, farce, so then yes, maybe someone should ask themselves the question. So for example, I think the former governor introducing the peer legislation is something good. The idea of pushing private markets is good. But ultimately, the reality is made today 100 the savings in the European Union through fiduciary mandate, means through either insurance or banking products, which, by the way, by law, is the only places where you can keep your cash. Yeah? You cannot keep your, if you want to invest with BlackRock, you try to give him money, he gets arrested. Yeah? You need to go through a bank and an insurance. Yeah? None of you can go directly by him. So basically, going through an intermediary made 100 the savings. We as Europeans have less than 1% of our savings into companies which are not listed. We are only 70% of the jobs. Now, why? Because the large players have been benefiting by saying liquid is good. So now they want to go and take our own deposits, which finance those through SMEs, and place them into listed liquid, guess what, in America.
I mean, obviously, these are all very fair points. I mean, you also know that, and you know, discussing regulation and trying to influence regulation, of course, is important. I mean, it may take time. I mean, often it takes a very long time. So I'm just wondering whether in the short term, however, you know, what kind of practical solutions, I mean, just going back a little bit to the banking sector, can we see? I mean, we've discussed consolidation. We talked about the fact that the US banks are pretty much, you know, eating the lunch of the European banks. I mean, is there a possibility that through consolidation we can somehow revive maybe the European Investment Bank, or is that a complete, you know, out of the window type of situation? We'll never see that again. I mean, what do you think, Alberto?
If you compare our situation like Davide was doing before with the US, we need to start from the reason why US is there. First of all, US is a real single market, speak only one language. I shouldn't say that they have the same fiscal treatment, but overall is the same. But what is really important is they have banking union, which we lack, and we have to start from that. We have seen clearly the proposal of Olaf Scholz published in the newspaper at the end of December, that we can say is a very timid step ahead. Why? Because just to remind, Scholz mentioned 3 main points. He started, strangely enough, with the need to have a resolution system also for the less significant bank, which nobody really cares. Then he mentioned a second, they're in Germany, but I mean, because they have a lot of
so many banks.
Yeah, so many banks. Yeah. But you know, it's not a priority for the Europe and for the banking union. The second was, you know, addressing the limit on govies and the risk reduction. So he mentioned risk reduction, like what we have done in Italy is not enough, but we know that there's been a huge effort. And then he said we need to tackle the problem of govies in the bank's balance sheet. And I think rightly this has not to be a taboo. But it has to be something well done, because I honestly share the view that considering a totally free risk govies, the market tells you that is not a reality. Just mention what happened in Greece some years ago and you will realize that it's not free risk. It has to be done very progressively and with an idea that the concentration risk can help also some countries like Italy, because at the end if you put concentration risk, this means that German banks cannot invest only in German bond but have to invest also in other, and our market is one of the most liquid and big. But it has to come with a totally different third point. Where he completely disappointed us clearly is on EDIS, because the definition of the German Minister of EDIS is something like, okay, EDIS happen when everything else has been exploited, like national fund, then European financing fund for them. So at the end, he played down very much this. So EDIS is, as Enria said in his latest interview, one of the first important measures to be introduced. Otherwise, also trying to build a European bank, I have some doubt about the merit of an investment bank, a pure investment bank. Why? It's simple, because if you see, in America, all the investment banks have turned into conglomerates. The only one that stayed IB used to be, and is still a very important bank, Goldman, is facing more orders today. So I think creating a truly European investment bank doesn't make sense because of the lack of a common market and a banking union, but also because investors won't buy the equity story. They will buy something like more conglomerate bank, like having investment management activity, consumer, retail. So if you want to pick up a name, an evolution of BNP Paribas that have such big financial muscle that can also absorb the volatility of IB activity that no investor like. So if you go with the story of a pure investment bank to investor, they will tell you, okay, you trade a discount to book and we give you a low multiple. So I think there is a lot of activity to be done to create a precondition to have large European banks.
Okay. Maybe two follow-up questions there before we go to the audience, and see what questions they pose to us. Giuseppe, if I may go to you. So Alberto here just told us that he's not opposed, maybe introducing a sort of risk weight for, maybe Alessandra, I don't know if if you want to intervene as well, but what do you think? I mean, should we, to address the concentration?
I am not sure I understood that Alberto said that he would like risk-weighted govies. The problem...
Certain limit, I couldn't elaborate.
Yeah.
I think is not inconceivable that above certain limit of total govies that absorb 1.5, 2 times your tangible equity, at a certain moment you start to risk weight. So it's not something that you should start from the very low end, but if you are above certain...
So the problem is concentration, and I agree, because of course this would be beneficial for Italy, not a problem like somebody would hint in the Schulz paper. So what means that in Italy, which of course is a very liquid market, the only yield market for bond nowadays, I think up to 10 years there is no other market rather than Italy. So of course this would be beneficial for Italy. So I am not against saying set some rules about how much you can have in terms of ratio, capital to govies that you can have. Of course, this should come looking around what happened also abroad. If we need to have the European market, we cannot only look at the European market because the competition in the financial sector is worldwide. So already now we have only a part of the European market run by European bank, but most jewels of the European banking revenues, of course, are for international banks. So we have to look at everything. When you started saying regulation has been too tough or not, it's not a question of too tough or not. but it's a question of understanding what you need at that moment in order to make the economy grow. And I think this sometimes is a bit put aside. I don't know if because they are bureaucrats, I don't know if because the politicians are not doing the right job in order to address the strategy for the growth. And then we have technicians who have to develop the means and the possibility to have this politician view to be done, to be realized.
Okay, so before, yeah, and just, of course, I'll have your view, but just to understand, where does the Bank of Italy stand on this? So is it possible to address, if you want, concentration, maybe by means of introducing a risk weight without triggering a spread crisis, if we want to call it like that? Because this is often what people say, well, you can't touch it because otherwise, the spread is going to blow up and, this is going to endanger our debt sustainability.
Yeah. I think that after 5 years of SSM, I think we need to kind of relook a little bit at what the focus is, what the scope of our activity is. And I think that there is a big need also coming to this job, from the private sector. My feeling is that there is a strong need to understand the underlying economy of the choices that we make. And so the issue is, of course, to provide a supervision of banks and to use regulation the most appropriate way. But there are underlying issues of stability, underlying issues of economic growth, which are not on the immediate radar of these bodies. And I think that that's where probably we can try and make a change. These are,
So more growth and less stability?
Well, no, I think they have to go together. How that's possible, we're going to see. The issue is really like how we can move forwards in this. It's a huge sort of exercise of, I want to call it democracy. Sometimes it doesn't look that way. It takes a long time, but I think it needs to be we need to move the attention of these bodies towards the real economy.
You want to...
Just to add something, because we try to talk about how we help economy to grow. And in Italy, we are very different from other countries. When Davide was saying 75% of the people work in small companies, and we don't know how to help this company to grow. Because basically, this is only banking to do this job, because there are no other means, official means. And the banking sector is not pushed to help them because of the many rules, because of the needs to have perfect cash flow for every client, also if they have 1 million of turnover. There are a lot of problems in financing SMEs. And I think this is some issue that we should address. Otherwise, for our economy, it will be a disaster. And this is something that politicians have to have in mind in order to tell regulator that this is an issue. So we cannot force everybody to have the same rules to be applied.
Can I say something? Because we're discussing the banking union, but here we are entering another space, which is the capital markets union, because what we're discussing here, I completely agree, but again, to my previous comment, this is starting to happen. So I am, again, an investor, and if I look, by the way, global investor doing many different things. I agree, but actually I wouldn't underestimate the speed and the pace of acceleration, because again, I'm taking BlackRock as a benchmark because we are not a private equity firm. We do many different things. Amongst others, we do also invest in private markets. But when I look to the level of focus, a large, huge investor like us, investing in private markets is now taking the amount of resources that we are now refocusing on that area is because we agree there is a big gap. That does apply to Europe in general, it's not just specific to Italy. Clearly, Italy is particularly intense because we all know the amount of small and medium enterprises. But again, it will take time. But again, I wouldn't underestimate that the market is really moving fast. And I did mention before the LTIF. It is interesting to see how much noise we see. And when I say noise, it is in a positive sense. How much positive noise we see around the launch of these new vehicles that are intended exactly to facilitate the funding of the real economy. Because the issue is that we cannot have the funding to the real economy just in the hands of the banking sector. It doesn't work. And frankly, the big crisis was a very good example.
But for the time being, at least
I agree.
give the banks the possibility to do that.
Well, but the other thing is that the banking union is taking forever. Yeah, I mean, the pillars, you know, they're out there, still need to be built. I mean, we mentioned a few of these issues. So I'm also thinking whether we're coming to, you know, to look at an integration between these two unions that probably have to be looked at together.
I just am mindful of time. I mean, please, David, I'll bring you back to the conversation. But, you know, I'm also kind of keen to maybe have a couple of questions from the audience, and then maybe those remarks can be incorporated. So, Peter, you've been monitoring the questions that have been sent to us, and you've selected a few.
Thank you, Lisa. Yes, I have been. I've been monitoring the questions that have been coming through. Some of you all mastered the technology, although it's interesting that everybody who asked a question chose to be anonymous. So make of that what you will. You get a more honest level of question, I think, maybe this way. So just a couple I picked out. The first one maybe for the asset managers in the room. What are the key success factors for the evolution of ESG for the European and Italian banking industry?
And I start outlining which is probably the biggest challenge of ESG, which is data. So the biggest challenge for the effective implementation of ESG, and again, I'm using this terminology in a very broad sense, is the availability of quality data, which is the biggest problem. If you look to ESG today, and the way also, for instance, we do run ESG assessments, the issue we have is mainly about the data which is patchy. Very often, by the way, is also self-reported, so you have to trust the people that you are telling you what they're doing. It is inconsistent, and when looking to the the ecosystem of data providers, when you take ESG scores, the way they are assessed is not necessarily consistent. And this is particularly critical, and I think it goes back to Italy and to the banking sector, for the small and medium enterprises. Because if the situation with data is critical, when you go to the SMEs, it's a total disaster. So this is the big issue. But again, I tend to be positive, as you have noticed probably. What I see is that there is a lot of investments. So it is investments from the regulators and the supervisor that are helping to push the agenda forward. There are investments for the likes of us, for the players in the industry. For instance, as a shareholder, we are, I would say gently, now it is a bit less gently, pushing the firms we invest in to try to do their best in order to provide data, to disclose, to provide reports. So again, as before, it is not happening overnight, and we have to be mindful that this is a process that does need some time. The ecosystem is very complex. There are many different actors, but we are moving in a direction which is, in my opinion, in our opinion, the right direction.
Of whether this push towards more ESG, more sort of focus on the green economy is another sort of layer of regulation in a way that somehow hampers the banks, in their sort of quest towards profitability. I mean, how can you make a sustainability sustainable from a business model? I mean, I suppose this is, I don't know how much you're already incorporating the green economy and the sort of climate change challenges in your lending decisions, for instance.
Our view is a long-term view. You cannot think that you can have the same result if you push on one side in 3 months. But if you do, I think we have the obligation to think about future years and generation, and you need to switch. Like Alessandra was saying for the gender problem, if you don't start pushing some way, nobody will change. So it's very important for me.
Okay, maybe, Davide, oh sorry, you wanted to say something.
As I'm not to be politically incorrect, I'll be very politically correct this time. So when I started, a certain point in Morgan Stanley, I had 160 analysts globally. I fired 25, half went in S&Ps and Moody's. I'm on the record and always said it, that one of the reasons why rating agencies exist is to cover someone else's back. So when things go wrong, is that it's not my mistake. And one of the key problems globally, the massive subprime crisis we had, that was because there was lots of paper written AAA, people were getting a fee, they couldn't care less, 2 trillion losses, all fine. I think today ESG is the biggest greenwashing on the planet. I started, and my partner, Sir Chris Horn, The good news is, yes, the largest charity in Europe, $7 billion, is using $20 million a year right now to hold people accountable. We've already singled out firms. Then if you look at ESG, I just focus on E. We can do work on S and G.
Yeah.
G, by the way, on governance, I think we have done most in Europe to help people accountable, including regulators. On the E side, it's very simple. We're producing 40 gigaton per year. By 2050 COP, we need to go carbon neutral. So there's two ways to go carbon neutral. First, we had 6 trillion trees on the planet. Planet. Now we have 3. Each of us needs to look at his own carbon footprint, you guys. And I tell you what's the number. If you haven't done the numbers, it's 23 per year per person. So we have signed United Nations PRI. Look at our numbers. We had to plant 18,000 trees. We're planting 25,000. Now, we're a small firm, but at least I haven't polluted since day one I existed. If I were to do this, we've already solved the issue. Second point is, which is now the reason why I've always been super active, the passive industry, the ETF, so whatever is in the index, I own it, creates an issue. Because you can't say, hey, I'm going to make discrimination between being green, and then suddenly, oh, by the way, I own oil, I own coal. Why? And on our side, if you made the 40 gigaton issued, you can split it, but the worst we're doing now is coal financing. So for example, take Germany. They want to be green, close nuclear. Now 45% of electricity comes from coal. So the CO2 emission in Germany have exploded.
They're getting money from the EU to get rid of that.
So it's beyond ridiculous. As a result, I think what we have decided to do is, on every investment we do, we look at the footprint, we get their coal financing, and the beauty is, at least on the banking industry, made 39 indices, is today already the cleanest. I tell you why it's the cleanest. Because when I participate at BIS meeting, ECB meeting, World Bank meeting, the politician, feeling the pressure from the people, they pass it to the central banks. So the central banks now even need to be the ESG regulator. And so they're forcing the banks to do it. And so that's why today is actually the cleanest sector. So paradoxically, the cleanest ESG sector today is the banking sector. The worst, in my view, clearly is who produces coal. And then there is lots of greenwashing. Why? Like in the ratings, it became a new business. So stick a new label and off you go. And I think the reality is people will be held accountable, and it's up to the private sector independent. Here, with the thanks of Sir Cruson, I think we'll have lots of fun in the coming years, because lots of institutions will end up being in trouble. Why? Because ultimately, in 2050-60, I got 4 kids. I'm not taking greenwashing or, BS, because I have a fiduciary responsibility, ahead of my 4 kids, and each of you have the same. So, not because someone wants to make money short term, that we're going to let people free.
So, can I have one comment?
Yes.
Because, by the way, maybe, I don't know if I have to be more politically correct, but BlackRock has been pointed as someone doing greenwashing a lot. We are a large player. Larry has been very vocal for years now. The recent letter is particularly strong, but is not new. But let me give you my perspective as a practitioner of ESG. I don't want to enter a super high-level political debates, but what we are really doing and living within BlackRock, I can tell you, is exactly what I see every single day. The starting point is exactly what Giuseppe was saying, is the long-term approach. So this is really changing completely the perspective, because if you run your business, if you make investments, taking a short-term approach is a totally different view of the world than if you start taking a long-term approach. And on this point, we can say that Larry has been always consistent even before we were starting discussing ESG, even actually before anyone knew about what ESG means for, that a long-term approach is the way we run our firm. Starting from that, despite any conversation about greenwashing that I agree is a big risk and is also reality, I'm not saying that there is no any greenwashing, we started analyzing data. And with all the issues that we have, because the data, maybe the raw data, is not maybe perfect, there are a lot of imperfections, the evidence that we are starting to see more and more strongly is that if you build the investment portfolio, and when you select the securities, and when I say securities is general terminology because it's both, it does apply both to equity and fixed income, applying ESG lens with all the problems that those ESG lens have, the end result is a more resilient portfolio. And these numbers, and we have now a lot of examples, although the track records are still pretty recent, we go back to 2012 more or less, but the evidence is more and more there. And when I say more resilient, it's not necessarily that your portfolios are performing in absolute terms better, but the risk-adjusted return are starting to be very competitive. So frankly, this is numbers, and the reason why BlackRock decided to increase the level of pressure is clearly because we are under the spotlight. We are the larger asset manager in the world, so anything we do wrongly is potentially having a lot of implications, but also because a number of internal technical committees made of investment engineers had evidence that actually this is something that makes sense if you take a long-term approach to your portfolios.
Okay, so thank you. There's money to be made ultimately.
We have a few more questions, but maybe I can ask you one more, and because this should be a one-word or maybe 2 words or maybe a 3-word answer, which is what will be the biggest bank in Europe in 5 years' time?
Oh, okay. You can't answer.
I really don't care, but I hope to be a bit bigger than I am, but I don't know. Frankly speaking, I hope that we can have a single market. This is very important in order to have a good bank, strong bank that can compete with overseas bank, and to have banks that can also take care of SMEs. This, in my opinion, is very important.
But some names. Who wants to name names?
If you talk with all the CEO of the large banks, when you talk about M&A, big M&A, they all say to you, Alberto, it's impossible to do big step ahead because with the buffer of capital needed to go one step above, just to buy something that is smaller, we have to add a multi-capital to the one we have. So we need clearly to have a new regulation in terms of capital buffer that favor this. Otherwise, we won't see many move.
Let me tell you what every shareholder and every CEO wants is not to be bigger, they want to be fitter. So everybody wants to shed assets, so smaller, lose fat, and be stronger in your core. So they want higher return on equity, higher return on risk-weighted assets, less size, less complexity. And let me tell you why you'll not see cross-border consolidation. Why? Today, legally, if Alberto were to make, or actually take Giuseppe, makes a mortgage, yeah? For example, I have mortgages in 3 countries, UK, Italy, France. They're all different. The conditions, the letters, the law, how it's set. I have 3 credit cards across 3 different European countries. They're all different. I also have a US one. Guess what? Different. As a result, he has 0 synergies, economy of scale. In his business, he has massive economy of scale. That's why even a small firm can actually exist. We distribute in 22 countries. We have 3 million clients. I'm not smart, but the law allowed me to make one product in Ireland legally, and then I can sell it in 20 countries. Off you go. So the reality is, in banking, so far, they're paying the price. But the politicians talk one game, then in reality, the legislators are all protecting their own countries. They have allowed people like us to benefit. And so today, every CEO wants just to be smaller and more robust. But they're not thinking about size, because size is headache, problem, and complexity.
But what about at the domestic level, if I may ask? Because obviously we're talking cross-border, but domestically, I mean, there could be savings, and I'm thinking not just bank to bank, but what about banks buying asset managers? You know, I mean, that type of consolidation, yes or no? I mean, what is, I mean, we're here in Italy, we have 2 CEOs, you know, where is going to be the next step?
Share my real situation. If I should have money to do something, I would do this with, I would say, with a product factory, with an asset manager, with an insurance. But frankly speaking, in this environment, it's very difficult to think about 2 banks to be put together. And believe me, I tried it, and it was also, I think it was also a successful experience, but it's the only one in Europe. Mm-hmm. So this means something.
By the way, about banks buying asset managers, why? Because honestly, I was saying before, speaking before.
I don't want to buy BlackRock.
No, we can discuss it, Giuseppe. Maybe offline. It's more for Larry, but not for me.
You know, I know somebody who managed to be, who threatened to buy in order to be bought. So this could be.
No, sorry, just to finish on this, because I think it's an interesting point, because there is a lot of space for partnerships between banks and asset managers. So I think that when you look to the value chain, the banks that can really focus on the part of the value chain that is the most profitable for them, which is not necessarily the factory, but is the service model, the ability to serve their customer base, and then partner with the people that have scale. Sorry, here I'm a bit biased, or the capabilities, and I'm looking here to my friend, to become true partners. And this is, by the way, something that is happening. So I'm not just speaking
So you
about...
can survive as a bank just with a network, no factory, and partnering.
It depends it depends what is the factory. I think the point is how you define a factory. We often internally use this definition of meta factory. So it depends what is your manufacturing, because having a center of excellence, having a specialized unit that is in charge of product development, managing some asset classes, serving your customer base, which is a factory, makes a lot of sense. Building something like, an ETF business from scratch, I don't think it makes a lot of sense, because the economies, or maybe in some areas also, when you look to private markets, there is an element of specialization very relevant there as well. It doesn't make a lot of sense. So it is not having or not having a factory, it's what you put within the factory.
Yeah. But it's a matter that of the evidence that the banks that have better ROT in Italy are those that have all the product factory, because if you take into consideration just two names that I like, Intesa and Credem, not to mention Mediobanca, of course, they have a big profit pool and revenue pool that is coming from asset management, insurance, in our case, consumer finance. So basically, to come to your question, it does make sense to buy. I would look more at a wealth manager rather than asset manager, because asset managers are generally not having a strong distribution network, in particular if they don't call on themselves like BlackRock. So it's better to invest where you have also a distribution network or capacity. So the example that many banks followed in the past, and for sure Intesa did in acquiring San Paolo, is basically inheriting the biggest wealth manager in Italy, that is Fideuram. So I think there is space for Giuseppe, for us, for others, to try and build this kind of network over time.
I'm
because
expecting you to do something.
Yeah,
yes.
Because they prove to be very entrepreneurial. They prove also to weather situations like MiFID II. The impact of MiFID II, as you know, in Italy for the time being has been a non-event. Also because the network has been very valid and capable to deal the relation with clients, no? And also the claims and the kind of, I would say, reaction from clients has been very, very much mild.
Can I say why?
Yes.
One word why I think will be domestic consolidation.
Okay.
I'll tell you why. Take, for example, the only true success case in Europe, which is actually here. Now, 5-6 years ago, the ECB did a fantastic job at creating the SSM from scratch. They had to hire 2,000 people. I remember when we were in the Japan Tower, they were locked. They had to find the space. And through stress testing and then the various AQR process, they're now creating more and more and more level playing field. Now, you don't go from 0 to 100 within 2 years. I think after 5-6 years, been the highest success of any European institution, ECB and SSM. Today, because the NPL ratio is down, the balance sheet is clear, the problem has been identified, I think what will happen is the SSM, for the first time, if you have a bank that pass SREP 1 or SREP 2, and another bank, SREP 1 or 2, when you add the two, there will not be a capital deficit. Before, the SSM didn't trust its own data. Why? Each time they found another problem. And as a result, they said, NP were too high, so they said, I don't trust it. So I think what will happen for the first time, if you have a bank with 10, and if another bank with 10 plus 10, they will say 20 of capital. It's not we need 30. So far, you had no consolidation, because 10 plus 10, how much capital I need? 30. And standalone, they were needing 10 plus 10. So on logic, it was ridiculous. But the reality, what they were saying is, listen, there are too many unknowns. And I think under the leadership, remember, institutions are also down to individuals, yeah? Trichet hike rates before Lehman. Draghi said they'll do whatever it takes to save the euro. It's always the ECB.
Neuilly said what?
Neuilly won't comment. But I can tell you that
Neuilly said raise capital.
Yeah, Andre Enria has done a fantastic job, for example. And so I think he's going the right direction, and that's why we will see domestic consolidation, which is a function of two reasons. One, you need to reduce cost. And secondly, you cannot have so many banks if not prices will keep on being below cost of capital.
Okay, Davide, I hope to be there when that happens,
Yeah.
and I'll make sure there'll
Me
be
too,
a
because
woman
we'll make
CEO.
money.
Yes.
That's a good point.
Okay, that's good. So I think, on this note, we can end the panel. Of course, thanks our panel. Before you all go, I need to ask you to take the final two questions of our poll. One is, because we asked those questions, in all of the Breaking Views sessions, so please, if you could take out your phones, there's two questions. One is about, which investment will be performing best in the coming years. We also have the European banking, the Euro banking index, SoftBank, Blackstone, the British pound. Just sort of, give us an idea. Let's see if we have convinced. We haven't convinced you on the banks, I can see, because no one is voting for the banks. No one is voting for the banks. Well, someone is voting for the banks now. So Blackstone is number one. Okay, and the British pound? Yeah, number two. And the very final question, this is like, asking you to make a bold prediction, because this is like our predictions event. Which of these is most likely to be extinct? No, we didn't put banks. Forex traders. I don't know if you agree. Facebook. Forex trader. Oh, you can see it here. Facebook. I was expecting Facebook, but you still have a little bit of faith in Facebook. Okay. Well, listen. Thank you so much. Again, let me, a round of applause to our panelists. We had a lively discussion. We hope to see you again at the next Reuters Breaking Views prediction event. Thank you.